Ever scrolled through social media and seen people talking about buying the dip or investing in Tesla? Ever wondered what exactly they're buying? Well, today we're diving into the world of stocks, what they are, how they work, and why people get so excited about them. So, what exactly is a stock? Simply put, a stock represents ownership in a company. When you buy a stock, you literally own a tiny piece of that business. Pretty cool, right? Think of it this way. Imagine your favorite company is like a chocolate cake cut into thousands or even millions of slices. Each slice is what we call a share. When you buy a share, you're basically saying, "I'll take that slice of the company, please." For example, if a popular streaming service was divided into 10 shares total, and you owned 5 of those shares, you'd actually own half of that company. In reality, big companies have millions of shares, so you'd likely own a much smaller percentage, but the concept is the same. You might be wondering, why would a company want to sell pieces of itself to random people? Good question. Companies sell stocks primarily to raise money. Creating and growing a business is expensive. They might need cash to build new factories, develop new products, expand to different countries, or even just pay their bills. Instead of borrowing money from a bank, which they'd have to pay back with interest, they can sell shares of their company. The money they get from selling these shares doesn't need to be paid back. It's theirs to keep and use. Let me break this down with a story about Maya and her dream sneaker store. Maya wants to open Fresh Kicks, a store selling limited edition sneakers, but she's calculated that she needs $100,000 to get started. Unfortunately, she only has $50,000 saved up. Instead of taking out a loan, Maya decides to divide her business into 10 equal shares. Since she's putting in $50,000, she keeps 5 shares for herself. Each share is worth $10,000, so she sells the other 5 shares to people who believe her sneaker shop will be successful. Jordan, a sneakerhead, hears about Maya's business plan and thinks, this could revolutionize the local sneaker scene. He buys 1 share for $10,000, which means he now owns 10% of Fresh Kicks. With the money from Jordan and 4 other investors, Maya now has her $100,000 and can open her dream sneaker store. Fast forward 5 years, Fresh Kicks is absolutely crushing it. Maya has opened 3 more locations, and the business that was once worth $100,000 is now valued at $300,000. Remember Jordan who invested $10,000 for 1 share? His 10% ownership is now worth $30,000. If he decides to sell his share, he'd make a $20,000 profit. Not bad, right? But investing isn't always a success story. What if Fresh Kicks struggled to compete with online retailers and the business value dropped to $80,000? Jordan's share would then only be worth $8,000, meaning he lost $2,000 of his investment. Ouch! This is exactly how stocks work in the real world, just on a much larger scale. Some companies also share their profits directly with shareholders through what's called dividends. It's like getting a slice of the profits just for being an owner. So where do people go shopping for these company slices? They go to what's called a stock exchange. Think of a stock exchange like a marketplace where people can buy and sell shares. The most famous ones are the New York Stock Exchange, NYSE, and NASDAQ. These days, you don't have to physically go there. You can buy stocks right from your phone through investing apps. When a company gets big enough, like if Fresh Kicks expanded into a national chain with hundreds of stores, it might go public by listing on a stock exchange. This allows anyone to easily buy and sell shares of the company. Now, not all stocks are created equal. When companies issue stocks, they typically come in 2 main flavors: common stock and preferred stock. Think of them like regular tickets and VIP tickets to the same concert. They both get you in, but with different perks. Common stock. Common stock is what most people think of when they hear stocks. When you own common stock, you get voting rights. That means you can actually vote on important company decisions and help elect the board of directors. Got 1 share? That's 1 vote. Got 1,000 shares? That's 1,000 votes. You might receive dividends, but these aren't guaranteed. If the company has a rough year, they might decide not to pay dividends at all. The big advantage? Common stocks typically have the highest potential for growth. If the company does really well over time, your common shares could skyrocket in value. The downside? Higher risk. If the company goes bankrupt, common stockholders are literally the last in line to get paid after all the debts are settled. Sometimes that means getting nothing at all. Preferred stock. Preferred stock is like the responsible older sibling of common stock. Here's what makes it different. Preferred stockholders usually don't get to vote on company matters. You're giving up that influence in exchange for other benefits. The big perk? Guaranteed dividends. Preferred stockholders get their dividend payments before common stockholders, and these dividends are usually fixed and reliable. If you're looking for steady income, this is attractive. If the company goes bankrupt, preferred stockholders stand in line ahead of common stockholders, but still behind people the company owes debts to. Think of preferred stock as a middle ground between stocks and bonds. Less risky than common stock, but typically with less growth potential too. So, which is better? It depends on what you're looking for. If you want maximum growth potential and don't mind the risk, common stocks might be your jam. If you want more reliable income and less drama, preferred stocks might be more your style. Why would anyone want to put their hard-earned money into stocks when they could just keep it safe in a bank account? Simple. Potential growth. While a bank might give you 1 to 2% interest annually, stocks have historically returned around 7 to 10% per year on average over the long term. Of course, that comes with more risk. The stock market can be a wild roller coaster ride. Some people invest in stocks for the long term, hoping the companies grow over many years. Others try to make quicker profits by trading, buying and selling stocks more frequently based on price changes. Final thoughts. So there you have it. Stocks in a nutshell. Remember, when you buy a stock, you're not just buying a random thing that goes up and down in price. You're buying actual ownership in a real business. If you're thinking about investing, start with companies you understand and believe in, and don't put all your money in one stock. That's like putting all your eggs in one basket. Thanks for watching. If you found this helpful, hit that like button and subscribe for more videos breaking down financial concepts into simple terms. Drop a comment letting me know what financial topic you want me to explain next.